How is a business plan used to secure a business loan? Well, many startup ventures or small businesses need external funding for operations, so going to a business lender is a common practice. Part of the application process for a loan is to turn in a business plan. The business plan has numerous aspects that explain the business, give information and background on the founders, and show what the business is going to do or what is projected to do in the future. Making certain that you include the important elements is essential to actually securing the funding. You are going to need to meet all the requisites of the lender, particularly the loan officer who is evaluating the loan to determine whether to make the loan or not. So, what is the lending officer looking for? To start with, the concept of the business. What is the value proposition? What do you do? What problem does it solve and for whom? The value delivery to the customer, client, or end user. What is it? Who are they? Explain that in detail. Make certain it's obvious to the lending officer that there is an existing market out there and they will value what you're delivering. Management team. Who's going to run the business? What is their background? Do they have ability to do this? So having a strong track record, bragging, building out the credentials of the individuals involved is important, because remember, these are human beings. It's not a computer making the decision of whether to make the loan or no. This is a very subjective determination. So having individuals on your team with credentials and the apparent ability to adequately run the business is crucial. Okay. Detailed operations. Explain what it's going to take to run your business. What is each step of the value delivery process, and what does it take for you to receive value back? Account for every step. Make certain you can demonstrate what needs to be done, who is responsible for it, along what timeline. So anybody reading the plan can understand how the business is going to run or operate. Then, very importantly, the financials. A lender is in the business of providing you a resource that you need, capital. Capital is their inventory. So if they are going to provide you the capital that you need, they want to know how you're going to use it. What are you going to spend it on? Generally, a bank wants to be certain that they are going to be able to recoup the money that they lend in the event you're unable to pay. That is why organizations such as the Small Business Administration of the United States step in to secure loans that are made by these lenders to new businesses. They sign a guarantee or provide a guarantee that if the borrower cannot pay back the loan, that the U.S. government will pay at least some portion of the loan back. This is what provides the lender enough security to make the loan to the new business. With that being said, if the borrower cannot pay the loan back, the obligation that they have to the lender is primarily paid by the U.S. government, and then the individual has a debt to the U.S. government. So the debt's not forgiven, it's just shifted over to another party. And that's an important offering of the government to help promote the development of new business. But the bank still wants to make certain that you're going to be able to pay, so they want to make certain that you're spending your money on things that if you don't pay, that they could go back and foreclose on. They could claim it and sell it, right? They could, example would be equipment or inventory, something that has a ready market out there that, once again, you don't pay, they reclaim it, they sell it, okay? They don't want to see you using your money on payroll. They don't want to see you using your money on marketing, which is essential, particularly for growth-based businesses or startups. So with that being said, focus on the equipment and the other operational things that can be reclaimed in the event that you can't make payment. Real estate is a good example. Okay. And then they want to see projections on revenue. That is, how much are you going to make from your operations? Does it look realistic? Does it look feasible? Is there an adequate period of time where you can cover the absence of sufficient revenue to meet your payment obligations. That is, are you going to have enough cash on hand to meet your obligations until you reach break even and become profitable? So they'll look at your ability to repay based upon whatever your loan payments are and what other fixed and variable expenses you have as part of your financial projections. So whatever the bottom line is with regard to how much you're going to make versus how much you're going to owe on a month, and how long is that going to go on for, and how long will it be before you turn profitable, and even when you turn profitable, is it feasible what you are projecting? So these are the things that the loan officer is going to look for. So there's a heavy focus there, again, on use of capital in a certain way and a detailed understanding of the business. This is very different from how a business plan is used when you're trying to attract investors in a growth-based or startup venture.